Good morning, everyone. Welcome to this update for global stocks and commodities for the 12th of May. Everything had been running along quite nicely. Sentiment was reasonably positive, just getting slowly better and better. The S&P broke out to new highs and everything looked lovely. And then the trade war rears its ugly head again and shatters the calm that we've seen for most of this year. So, the question is where to from here? And that'll be I guess the thrust of this weekend's update. So what it's done, it's created, I don't think it's really changed anything much, but it's created a large degree of uncertainty, and the markets hate uncertainty, and so it's more sentiment than the fact that's the problem. Now, you'll recall that there were effectively three things that led to the pullback of last year. And I'll come back to that when I get onto that slide. So one of those three legs is now back in place, and that's the trade war. So we'll be looking at the normal stock and commodity trend update. And last week in Portfolio Analyst, I looked at how fund managers, mainstream fund managers, and hedge fund managers, how their psychology influences the market, and it is quite substantial. And we also looked at a local stock that it's only small, but it has enormous long-term potential. So turning to the American market, the S&P ended up losing 65 points on the week, but certainly did steady on Thursday and Friday. Now, as I mentioned, there were three factors that caused the big sell-off that we saw in the final quarter of last year, where the S&P was down almost 20%. And one of those is now back. It's unpredictable because both Trump and the Chinese are unpredictable in terms of what they're going to do. And frankly, and I guess with the benefit of hindsight now, it's probably a bit unrealistic to expect some wonderful trade deal to be concluded, because the US and China just have completely different agendas. They're coming from a very, very different place. And I don't think either side is going to give in too readily. So I'm sort of starting to think in terms now that this trade negotiation, call it what you will, is going to go on for years to come. And there's going to be very small incremental concessions on both sides rather than one big overarching agreement. I think that's probably the way this is going to play out. So in the last quarter of last year, monetary tightening was the single biggest factor that the market was worried about. No question about that. And that is now effectively gone. The second one was the trade war, so that was probably second in importance. Everyone thought that it had now gone away and that we get a negotiated settlement, but I think it's pretty clear now that that's now not going to happen, and I don't think we should expect anything to happen in the near term. So the question is, what are the ramifications of that? And then the third thing, in lesser importance to the stability of the stock market, was the fear that the inverted yield curve would lead to a recession. Well, I think quite clearly, that's now not going to happen. But what a lot of people are saying is that, well, if the trade war between China and America goes on, then that's going to affect global growth. Well, maybe it will, maybe it won't, but that's just supposition at this stage. At the moment, the US is going well, and China is also actually going a lot better than people are giving it credit for when you actually look at the data. So one of the three factors that led to that big pullback last year has come back, but most other things would support the market going higher, and particularly so earnings season. Now, the US dollar was down slightly again last week, but it was very, very marginal, and the 10-year Treasury yield slipped to 2.47%, which is what you'd expect. A bit of money going into the bond market with the fear of this trade dispute, and also North Korea firing off a couple of missiles didn't help matters either. So let's jump in and take a look at some charts. and we'll start with the S&P, and let's just start with a monthly chart. So this is the long term. Here's 2009, which was the bottom of the GFC, and you can see that we're starting to get into a period now of more volatility. So you can see we've had a couple of ups and downs. Yes, we've formed some marginally higher highs on both occasions, but in the first instance here, it was just 3 or 4 months down and then off again. And this went a couple of months down and then a couple more months sideways and then up again. Now, there's no question that we've now got more volatility than what we had down here, and that's exactly what you'd expect. But that doesn't mean that we're at a top. This could go on, and bear in mind each one of these candles is 1 month. This could go on for, another 12 or 24 candles yet and just go into a big sideways reaccumulation zone. I mean, that's equally as probable as any other outcome. So, let's not throw the baby out with the bathwater at this stage. This is the S&P. So we had 3 levels to break through. Here's the first. Here's the second, which was the 2018 January highs. And then the 2018 October highs, we managed to scramble above basically for just a couple of days, and then we've come off again. But let's look at the price action. The red 200-day moving average line just flattened out a little bit, even with the big dive in the last quarter of last year. Only flattened out a little, but is now rising again slowly. The 50-day, the blue line, is back above it, and the price has managed to hold the 50-day. So any trend that is holding above the 50-day moving average is still a pretty strong trend. So it's advisable to go with what is rather than play a guessing game with the market. So at the moment, we've had a bit of a pullback, might pull back further. I really don't have any strong opinion about the short-term direction because it is just so dependent on the psychology of the market and the sentiment of the market, and that can just change absolutely on a dime. If Trump starts a war of words with North Korea again, then that would certainly not be helpful at this point in time. So it's completely unpredictable. Let's not stress too much about it because the main trend remains to the upside. This is the US dollar index. So you can see we've still got a pretty clear upward trend in the US dollar index. And while I'm here, that's taken the Australian dollar down. We got below 70. In fact, I think we spent almost all of last week below 70. And you'll notice that we're now spending more and more time down in that trading range. So that's the Aussie dollar. Now, turning to the ASX 200. Oh, and just one other point that I was going to make, because a lot of people are sort of pointing to the trade war with China, that the supposition is that will put China's economy into reverse, and that will cause a global recession. Now, there's probably little doubt that the health of the Chinese economy is incredibly important to the overall global scene, but you've got to work with the facts on China and not with the stories that are made up by people that have got a particular point of view to peddle. And one of the facts is that the manufacturing and services sector index is positive, and it's almost at a 9-month high, the print that we've just had. So, there's no recession in China. They're actually rolling along quite okay. Yes, they've got massive debt, and that's a problem, but so's the US. And the US has been in that debt position for a long time. So my message there is, look, let's not jump at shadows when it comes to some of the fairly misleading things that I'm sure you're reading about the US and Chinese economies. So that's the ASX 200. We managed to scramble up to almost 6,400 points before pulling back a little bit last week. So our dollar finished exactly at 70, and the ASX 200 was net was down 25 points on the week. And as I've been saying for some time, very few opportunities that I think which offer a good risk for reward equation are in the top 100. There are a few, but not too many. But there's a lot of small and mid cap stocks that offer very, very attractive propositions. Turning now to precious metals, gold was up a little bit thanks to the dual things about North Korea and China. And that corresponds to an Australian dollar gold price, which is very strong at 1838. So most of the Australian gold producers, the mid-tier ones, have got an all-in sustaining cost somewhere between $1,000 and $1,200 an ounce. So that gives them an extremely healthy profit margin. And you'll find that most of them are debt-free and have got a few $100 million of cash on the balance sheet. So they're in a pretty good position. GDX on a global scale, the gold majors are still struggling to gain any real traction. If you want to make money out of gold stocks, then it's really the Australian mid caps is where all the action is. I'll just check in on the gold price while I'm here. So there's the gold price on a weekly chart. So you can see we've just been in this weekly consolidation now, and really you can go back to 2013. So we're still in this. We're still at the same level that we were in 6 years ago. That was the end of June 6 years ago. So no real progress in gold, but that happens. If you look at gold over the last 100 years, it's not unusual to see very, very lengthy periods where gold is effectively out of favour. And it's not so much that it's that much out of favour at the moment, it's just it's not in favour. People aren't really chasing it hard. Okay, copper was down to 278, mostly about currency, and crude oil was pretty steady, just below the $62 mark. And surprisingly, it's still holding above its 200-day moving average, and that is despite the global fears about growth re-emerging. So I think that's the price of crude oil. If the fears about a global slowdown were real, crude oil wouldn't be trading at $62 a barrel. It'd be something significantly lower than that. But there is an absence of momentum in the whole energy stock area, whether it's producers, drillers, explorers, refiners, pipelines, doesn't matter what it is. They're all pretty lackluster at the moment. There's our spot copper chart down over the last month or so, and the copper inventory in the London Metals Exchange warehouse had spiked up, but came off the boil a little bit last week. There's the crude oil chart. So we got up above 66. We've slipped back to just below 62, but there's still quite a bullish trend there in crude oil. So wrapping it all up, this is a time to shut out the noise, and there's a heck of a lot of it out there at the moment. A lot of people are throwing facts around that aren't really correct. They're throwing opinions around that definitely are based on emotion, not based on fact. The bottom line is that the main technical trend is up and it's intact, and you saw that from the charts. And also the earnings in the US support the trend, and the valuations support the trend. We're not quite through earnings season yet in America, but 76% of companies in the S&P index have beaten expectations, and that was despite the fact that 2018 was the one-off tax cut year, and therefore expectations came down quite a bit, and profits came down quite a bit in terms of percent growth, but nevertheless they're still good enough to support the trend. And of course the valuations are only fractionally above the long-term averages, which is fine because interest rates are well below the long-term averages. So those two things match up fairly nicely. So time to shut out the noise. That's the actual fact of the matter, and that's really all you should go with. Anything is possible, particularly in the short term, but I would encourage everyone to consider what is probable. And we've had the trade disputes and rises in interest rates and all those issues have been running now for a long, long time, and the market just continues to set new highs. So, that's what's probable. Trying to anticipate what comes next usually ends in grief. So I think just keep it really simple. Buy a dip in the market. At the moment, though, it's probably not a bad time. We're into the middle part of the year when, if the market is going to be a bit weaker, this is the time of year when it's more likely to happen. So it's not a bad time to have a bit of strategic capital. And by that I mean maybe taking some capital off the table if a position that is profitable has become too large. Then trim a bit of profit out of that. Or if you've got some stocks there that you don't really want to hold for the longer term, they may not be the highest quality. It's probably a good time just to to rationalise those, get rid of them, build up a bit of strategic capital. Because if we were to get a 5 or 8% pullback because of a bit of short-term panic, then that'll open up some wonderful opportunities, and you want to have some capital for that. So I think moving along that way, just examine your portfolio and just see if there's any housekeeping needs to be done there. Portfolio Analyst this week, again, it's just a continuation of lining up the possibilities in both countries. There's plenty of them, and as the market pulls back, they just become more attractive. So that's it for this week. There's my contact details for any non-members, and I'll be back with you next week. Cheers.